Pivot points are used by Forex traders to locate potential support and resistance areas. They are levels where price interaction may cause a reaction. In addition, pivot points help traders confirm the bias and sentiment in the market over a given time interval. A pivot point is calculated as an average of significant prices, high, low, and close, from the performance of a market in the prior trading period. If the market in the following period trades above the pivot point, it is usually evaluated as a bullish sentiment, whereas trading below the pivot point is seen as bearish. Pivot points are considered leading indicators as they have predictive qualities. Many Forex traders prefer to use pivot points over many other types of horizontal levels as they are more objective and easy to understand. Pivot points are a tool that can help traders recognize points of interest where traders are likely to see increased order flow. Traders tend to place stop-loss orders and take profit targets around these levels, so there's a higher chance of activity that can cause price rejections or breakouts from these levels. Many Forex traders are aware of what pivot points are and may even incorporate these support and resistance levels into their trading strategy, but there are many different variations of pivot points. The ones you are most likely familiar is the standard pivot points. One of my favorite type is the Fibonacci pivot points. Fibonacci studies, such as retracements, extensions, and projections, are quite popular in the financial markets. The primary Fibonacci levels that traders watch most closely are the 38.2 and the 61.8 retracement levels. But did you know that you could incorporate these Fibonacci levels into a pivot point calculation as well? In fact, it is very similar to the standard pivot points, with the additional inclusion of the 38.2, 61.8, and 100 ratios. Fibonacci pivot points method uses the same formula to determine the central pivot point level as the floor traders pivot method. The support and resistance levels are calculated by using Fibonacci retracements and extension levels of the previous session trading range. Fibonacci pivot points can be used in two ways: to spot the main trend of the traded instrument, or use them to enter and exit the market. To identify the direction, if the price level of the pivot point is broken in an ascending move, the market is bullish, and if it breaks below it, it is bearish. Generally, if prices hold above the Fibonacci pivot point, it can be said that the market will be uptrending, and if the price holds below the pivot point, the market is downtrending. So the simplest way to use Fibonacci pivot points are as regular support and resistance levels. Here are some important tips regarding Fibonacci pivot points you should be aware of. First, the more times the price touches a pivot level, then reverses, the stronger the level is. If the market found rejection at that particular level, it means it holds a great significance for market participants. Here are some examples of Fibonacci pivot point rejections. The second tip: support 1 and 2 and resistance 1 and 2 of Fibonacci pivots may cause reversals, but they may also be used to confirm the trend. For example, if the price is falling and moves below S1, it helps confirm the downtrend and indicate a possible continuation to S2. If the price is increasing and moves above R1, it helps confirm the uptrend and indicate a possible continuation to R2. Here are some examples of continuation moves after the breakout of S1 and R1 levels. Now let's see how to trade using Fibonacci pivot points. This trading strategy is very simple, but is one of the most powerful ways that you can take away from trading with Fibonacci pivots. The trading rules are straightforward. If we are in an upward trend, with the market making higher highs and higher lows, you will look to buy at support at either S1 or at the main pivot point, with your target set at either R1 or R2. If we are in a downtrend, with the market making lower lows and lower highs, you will look to sell at resistance at either R1 or at the main pivot point, with your target set at either S1 or S2. Also, don't focus on S2, S3 or R2 and R3 levels in a strong upward or downward trending market, since these levels are not often tested during a strong bullish or bearish advance. So remember that this is a trend following strategy, not a pivot reversal strategy. Looking at this chart, you can see the importance of Fibonacci pivot points and their accuracy. In this example, we determined the main upward trend by analyzing recent market swings. You could also add a moving average for a better visualization of the trend. I prefer to use longer period moving averages to confirm the trend, like the 200 or the 100 moving average. During this rally, we have consecutive days of higher pivots. The central pivot point is the most important part for me. The location of the main pivot point on the chart represents a critical information to be aware because there is a high probability that it will be reached. That's why I prefer to compare the value of the main pivot point with the value of the previous day, and if the current pivot point is higher than the previous one, I consider taking only long entries. If the current pivot point is lower than the previous one, I consider taking only short entries. So coming back to our example, you can observe that the main pivots are well separated and are acting as a perfect area of support. S2 and S3 are never touched during these days, so we look to buy around the central pivot point and S1 levels, using price action or any other technique you prefer. You can also use indicators to spot your entry. The choice is up to you. Here are other examples of trending markets and opportunities to buy or sell using Fibonacci pivot points. You can also merge the Fibonacci pivot levels with regular Fibonacci retracements to discover trade entries. The best combination from my experience is the daily central pivot point, or the S1 or R1 levels, with the 38.2 and the 50 Fibonacci retracement levels. Practically, you draw Fib levels, and you want the retracements to correlate with pivot points, like in this example. Observe how the retracement level practically coincided with the Fibonacci pivot point, which is a powerful signal. There are a number of variations and potential entries for this specific strategy, from candlestick patterns, trendline breakouts, or even entries based on indicators. So we look for a confluence of Fibonacci retracement levels with the daily central pivot point, or S1 and R1 level. If price retraces to the identified confluence, either enter at the market or wait for a candle signal or any other trigger at the confluence zone. Obviously, it is more risky to enter before getting the confirmation signal, but such approach gives a higher risk-reward ratio. Here are other examples of entries based on retracement levels and pivot points. While trading with the Fibonacci pivot points, you have to follow some important rules. You have to use money management and risk management techniques. Also, you should take into consideration the features of the certain markets where you conduct your analysis, because the price reacts in a way on the Forex market and in a completely different way on the stock market, for example. Ideally, Fibonacci pivot points have to be used with other methods of analysis and forecasting of the behavior of your instruments. From my experience, it's better to use Fibonacci pivot points on the charts from 1 hour and higher. The higher the time frame, the stronger the signal will be. If you enjoyed this type of content, give it a thumbs up to show your support. Also make sure you subscribe and hit the bell icon to get notified each time we upload. Until next time.